Okay, well, we have kind of a large crowd tonight, and again, let me say just very briefly, thank you very much for attending, and I hope that you find tonight's webinar worthwhile. My name is Jeffrey Kennedy. I'm the editor of Futures Junctures, and many of you are Futures Juncture subscribers. Some of you are not, so again, thank you very much for attending. If you are Futures Juncture subscribers, then you know that really at the end of each year I begin to do something called annual Fibonacci support and resistance analysis. And it's very fun to do. And simply all I do is, and let me pull up a couple of appropriate slides, and I'll be showing this technique a little bit in greater detail as the evening unfolds. But simply what I do is I take January's trading range, right here. This is January. This is a monthly bar chart. I simply take January's trading range from the high to the low and project it upward from the January high. And what happens by doing this is it identifies significant levels of resistance throughout the year. Also, too, you take the same January's trading range and project it downward, and again, significant levels are identified throughout the year. Now, just so I don't get too ahead of myself, I'm going to show you some very dynamic applications of this technique that I have not previously divulged before in my writings. As you now know, the technique, I simply do it on an annual basis at the end of the year. So let's go ahead and get a little more familiar with the approach. And simply put, I'd just like to walk you through a couple of slides and a couple of charts and just simply, hey, would knowing these price levels well in advance actually be helpful to you as a trader or as a farmer or as a speculator? And these are the levels that can be identified with the technique. And I think these are very valuable levels. Here was a resistance level that was identified utilizing the technique. Here was a support level, another resistance level, and as we came into the end of the year, certainly a floor a little bit above $8 a bushel here in soybeans. This is a weekly chart, and again, these levels were derived utilizing, again, January's range. The high in January, the low in January, simply take the range of that bar, the monthly bar chart, and project it upward or downward to identify either resistance or support. Now, here's where the rubber meets the road, and again, here's the work that I have not published before. The technique works on time periods more than just the annual time frame. Here is, again, would these levels be useful? Notice, too, very importantly, this is actually an individual stock. This is the stock of Google, and it's not soybeans. And these levels support, resistance, support, resistance, support, resistance, resistance, and again support. These levels can be determined well in advance and I think tend to prove significant throughout the month. If we go lower, this is a 60-minute price chart, and again, this is of a market I tend not to look at. I certainly don't write on it, and this is the 10-year Treasury note. Again, resistance, support, resistance, and support. And here's where it even gets even more exciting. This is a 5-minute intraday price chart of the Dow Mini. And again, these are the levels that are identified utilizing this technique, this period Fibonacci analysis. So again, what I would like to do at this point is actually show you how I apply it on multiple time frames to identify significant levels of support and resistance. And just since I have a kind of I do like the E-mini market, E-mini S&P, E-mini NASDAQ, and Dow with regard to a trading vehicle, these levels are indeed very significant, even for the day trader, and they can apply the technique themselves to identify these key levels. So let me step back for a moment and bring up another chart, and we'll just walk through a few examples of very clearly so that you know how to do this, more importantly, so that you know how to do this yourself. Okay, this is the annual Fibonacci support and resistance analysis part, step 1. Again, simply multiply January's trading range by the appropriate Fibonacci ratios, 0.618, 1, 1.618, 2.618, and 4.236. Now it does go higher. The Fibonacci ratio sequence actually goes much higher. Beyond 4.236, you have 6.854. Beyond that, you have 11.090. And beyond that, you have 17.944. But for the scale that we're looking at with regard to the monthly price chart, typically it's limited to about 2.618, 4.236. Now, step 2 of this is simply take, again, January's trading range and subtract it from January's low. Now, the end result will be this slide right here. Again, what I've done is I've taken January's trading range, project my Fibonacci ratios upward, and I've also projected my Fibonacci ratios to the downside. And let me highlight, again, the relevant points that were known well in advance, that were applicable, most importantly, throughout the year, that identified some very key levels that the market was attracted to, reversed from, and found support at. Okay? Now, I'm not going to spend too much time with the annual technique or the annual numbers because, number one, I've just recently written about the approach in the February issue of Monthly Futures Junctures. More importantly, in that issue, specifically the Trader's Classroom, in the back of the newsletter, I've actually identified and listed all the key and relevant levels, support, and resistance for all of the commodity markets I follow. That would be the softs, the grains, and the meat complex. I'm sure what most of you are very interested in is the application of this technique on a time period less than annual. So that's what we'll be doing right now. And again, it is very important to realize this approach is equally applicable across all markets and all time frames. Period Fibonacci analysis can be used to identify significant annual price levels, monthly price levels, weekly price levels, and daily and / intraday price levels. Okay. Now, what I do when I want to determine, now everyone already knows how I come up with my annual levels. Okay, how do I come up with my my daily levels, for example, for the month? And what I'm referring to is for the month of December. How was I able to identify the key levels for that month? Well, very simply. The technique doesn't vary. It just simply utilizes a different starting point. And in this instance, I will simply be utilizing the very first trading day of the month. I take the range of the bar from low to high, multiply that by the appropriate Fibonacci ratios, and extend those multiples upward. Now, as you can see, what we've seen in this instance here is once the first trading day was realized, we were able, so really come day 2 of trading in Google, we knew exactly what the significant levels were going to be for that market for the remainder of the month. I think that's fairly powerful and important information to know. And as you can see in this instance here, Google prices went up to the 1.618 level here and turned back down. And we didn't quite hit support, but we came very close to near the actual high from the very first trading day. So that's where those two lines came across. Now, if we continue to the approach, and excuse the number of lines I'm actually drawing on my price chart. I know that can be somewhat of a distraction, but if you could, just bear with me. So again, in this instance, I simply used one trading day. And that's kind of what is so dynamic about the approach. I'm simply using one period to determine information which is applicable for the remainder of the month. We'll do the same thing in this instance here for January. This is the first trading day of the month. I'm taking basically the range of the bar, and I'm projecting it to the high and into the low. And as you can see, these levels right here, the 1.0 level and the 1.618 level, did come into play. And earlier in the month, actually the third day of trading, we came up and tested the 1.0 level here. Again, these levels were easily definable well in advance, actually after the first trading day of the month. So actually come day 2 of the trading of that month, you knew well in advance, well ahead of the crowd, what levels were going to indeed be significant for the market. And we can do that again for February. Again, you simply take the range of the bar of the very first trading day of the month and project it upward and downward. And as you can see right here, Google pushed right up to the 2.618 multiple of the very first trading day and then reversed. Very simple technique, yet very, very effective. So, and again, as I try to stress throughout my work, be it the daily futures junctures or the monthly futures junctures, whenever I employ a technique, it's critical that it's applicable across all time frames and all markets. And that's why I'm actually showing you an individual stock here versus, say, a soybean chart or a corn chart. Now, let's take this one step farther here. How do I determine key and critical levels for the week? Well, to do that, I actually need to change my price chart here. Let's go back to the Treasury bond example, 60-minute. Very simple. Let's use a week here. This is a 60-minute price chart. So what I want to do is I want to take the very first 60-minute bar of trading on Monday. Very important. I simply take the range of that bar and project it upward. Now, just to make things clear with regard to this price chart and specifically what I'm looking at is the time period. If you look at the bottom of my screen here, you'll see a black day, a white day, green, red, blue, and then back again. This represents Monday, Tuesday, Wednesday, Thursday, and Friday. So I'm simply applying this approach to the very first hour of Monday's price action. And as you can see, I projected my appropriate Fibonacci ratios to the upside and to the downside. And what you see here is nice resistance formed by the 1.618 ratio to the upside, and to the downside, we had the 1.618 ratio. Now, on an intraday basis, with regard to, say, daily price, intraday price action, so if you're a day trader, you may find this approach even more exciting. And let me erase these lines here. I simply begin with a 5-minute bar. Here is my initial. This is the very first 5-minute bar of the primary session in the E-mini Dow. I simply take the range of that bar, project it upward, and that provides Fibonacci resistance to the upside. Take the low and project it to the downside. Now, as you can see, a number of these levels did come into play and were indeed very significant throughout the trading day. It's a very simple technique how you can get a head start on the crowd with regard to identifying the key and critical levels throughout the day. And again, this technique is applicable on an intraday basis, just as I've shown you right here via the E-mini Dow futures. It's applicable on a weekly basis. You simply begin with the 60-minute price chart and work off the initial 60-minute bar of the day. It's applicable on a monthly level. You simply begin with the first day of the month and begin working your Fibonacci ratios off that. Now, if any of you have been subscribing with me for any length of time, I've actually been writing about the annual Fibonacci support and resistance level analysis for, I believe, about 4 or 5 years. And the reason I continue to do so is because it is indeed effective. Well, between you and me, it's equally effective on the daily level, on the weekly level, and on the intraday level. And just to prove my point, here's the E-mini Dow futures, 5-minute. Let's go to today's price action, and let's see how, again, applicable. This is about as real time as you can get, because the webinar, tonight's webinar, was scheduled well in advance of today. So there's really no way I can actually make this stuff up. And what you see is this was at the very first 5-minute price bar of today's primary trading, or the primary session of the E-mini Dow futures. Down here at 4.236, we found very nice support for the initial sell-off. Right about here, between the 0.618 and the 1.618, that provided resistance for the recovery off today's low. We came back down, pushed through the lower line here, but then bounced right back up, providing very nice resistance, i.e. the very high of the initial 5-minute bar. Here again we have support right here at the 1.618 level, and then as you can see, the market went right to the 2.618 level. We pushed just above it briefly, and then the market began turning down. Again, as you know, this webinar was planned well in advance. This is today's price action in the E-mini Dow 5-minute. So again, I can't make this stuff up. This stuff does indeed work. But again, let me just go back to the a monthly price chart of soybeans, and I just want to go through the technique one more time so that you're clear. And then what I'll do is I'll make some notes that you can write down and follow. Again, you simply take the first period, the first bar of any given period. That's the one that is most significant. This is January's trading range. You then take the range of that bar from low to high and multiply it by the appropriate Fibonacci ratios. You then extend it upward to identify resistance, as it was here and again here. And then you do the same approach. You take January's trading range and apply it to the downside, and then that will provide you support throughout the entire year. Okay, so basis the annual Fibonacci levels we use, and I'll actually say this slowly so you can write it down. When you're trying to determine annual Fibonacci support and resistance levels, you utilize January's trading range, or the month of January. If you're determining important, significant Fibonacci resistance and support levels for the month, you begin with the first trading day of the month. If you're trying to determine important or significant Fibonacci resistance and support levels for the week, then you would simply use the very first 60-minute price bar of that week. And if you're looking to apply the technique on an intraday basis, you simply begin with a 5-minute price bar, the very first 5-minute price bar. I tend to focus more on the primary session, so that's what I do. Now, when you apply this technique yourselves, and I encourage you to do so because I know many of you excuse me, are currency traders or stock traders or and actually E-mini day traders, you follow more markets than just simply the commodities. What you may find when you apply this technique, for example, on an intraday basis, is that you find more relevance or more reliability when you use, say, the initial 10-minute bar instead of the first 5-minute bar. I like the 5-minute bar regarding the E-mini Dow. I find a lot of reliability with that. For example, also too, or conversely, if you're looking at, say, currencies or the cash currency market, the FX, you may find that the 90-minute bar or 120-minute bar may be more important and show more relevance. But with regard to the markets, I tend to look at these are the parameters that consistently prove to be the most reliable. Again, I use for annual levels, to determine annual levels, I use January's trading range. To determine monthly levels, I use the very first trading day of that month. To determine weekly levels, I use the first hourly bar of trading for every week. And on an intraday basis, I use the very first 5-minute price bar of that day. At this point, that's pretty much the cat's out of the bag with regard to the approach. So at this point, and I see I'm about 30 minutes into my presentation, what I would like to do is actually see if there's any questions that you may have regarding the approach. Again, it's very simple, and I will stress to this, for such a simple approach to be effective, it's very, very worthwhile. Having said that, I also know that there's thousands of different technical indicators and technical studies that are out there in the marketplace and that are in many, many books on technical analysis. What's important is that you find one or two or three that really ring true with you and that you can find that are applicable and worthwhile. If this approach and this technique, you find some usefulness with it, excellent. I'm so glad to hear that. You may follow it and realize that it doesn't really fit my trading style or my analytical style. That is fine. But for something so simple, I really encourage you to just keep an eye on these levels throughout the trading day, throughout the trading week, throughout the month, and throughout the year. And I think over time, what you'll see is what I've seen, that more often than not, these levels are indeed significant. The market does react at these levels, which is, again, why I've been following this technique for 4, 5 years or more. So let me go ahead and begin asking some questions, or answering some questions here. Okay, here's a question here regarding the 5-minute example of the Dow E-minis. Okay, let me go back to that 5-minute chart. Again, on the 5-minute level, or as far as the day trading perspective, I tend to focus more on the primary session. Okay, and the question is, so tomorrow, will I come up with new levels? And the answer to that question is yes. These levels that I've identified here, utilizing this initial 5-minute bar in the E-mini Dow, these levels are most appropriate and most significant for today's price action. Now, if I was using the weekly chart, i.e. that 60-minute hourly bar, those levels would be applicable for the remainder of the week. So really what I want to do is wait until tomorrow. I want to wait for the first 5-minute bar, whatever that may be, and then begin working off those levels, possibly in conjunction with the levels derived from the 60-minute price bar, which occurred on Monday. So on the 5-minute or intraday basis, I do calculate or recalculate my levels on a daily basis. Okay, here is a very excellent question. How do you determine if support and resistance are going to hold or if prices are going to be breaking through those levels? Okay, very simple. Now, and this is an excellent question and one I've been wanting to answer for a long time, and it's a difficult answer unless you actually can see the example. So, give me just a moment here. Okay, pretend for a moment that this is actually an individual price bar right here, and it doesn't matter if this is a monthly price bar, a daily price bar, a 60-minute price bar, or a 5-minute price bar. Now, one way you can determine how significant these levels are is if you see one of these things happening. And I'm sure many of you are Elliottians. You can actually work the technique in very nicely with an Elliott wave approach. So, for example, to determine if whether or not the 2.618 level is going to be important or significant, oftentimes what you'll find is within wave 3, you clear the clear subdivisions. You know, basically down in this point here, you have wave 3 of 3. Well, if you have a wave 3 of 3 count or a 1-2-1-2 count at this point, odds are you're going to slice through the 1.618 level and immediately project higher to the 2.618 level. So you can actually utilize this technique very nicely. It fits very, very nicely in conjunction with the wave principle because, as you know, the mathematical basis of the wave principle is indeed Fibonacci. So that's one approach you can actually use. Another approach is very, very simple, and that's simply using, this is a very standard, this is a stochastics indicator. I hope everyone is familiar with what a stochastics is. It was popularized by George Lane, and these are the standard settings of, I believe, 1433. Now, what you can do in this, whenever you're applying the approach with regard to the stochastics, is look for those extreme readings of overbought and oversold. They'll be very helpful in actually identifying whether or not prices are going to slice through one level and continue higher to the next one. For example, notice here as we move from this advance, from that point to where we actually have the cross between the %K and the %D, excuse me just for a moment, that the black line in this instance is above the red line. Okay, this basically means that the momentum is very strong, and odds are that as we advance, we're going to continue slicing through each one of these levels. But once we begin approaching the 1.618, and most certainly the 2.618 here, you actually see the black line and the red line basically become one. That's basically saying to me, my interpretation is that the market is overbought at this point. I'm seeing compression with regard to the %K and %D lines. We're at the 2.618 Fibonacci resistance for the day. Odds strongly favor against further rally onto the 4.236, onto the higher level of 4.236. That's one technique you can actually utilize in determining which one of these levels is indeed significant. Another approach that you can actually do is utilize, and this is just, I'm trying to stick with the most popular standard technical studies because I know most of them are going to be applicable with regard to most charting software. Here's the same approach, but in this instance, let me tell you first a little bit about the indicator. This indicator is a MACD. It is a standard MACD settings of 12-26-9. Excuse me. The MACD is actually a brilliantly designed indicator. If I only could pick one indicator, it would probably be MACD. That was developed by Gerald Appel in the, I believe, 1960s. And I won't get into the math behind MACD, but it's a very nice little indicator. And now, one of the things with regard to MACD, though, you must realize is that MACD is it's more of a momentum or trend following indicator. This type of a study is very appropriate when the market is trending. It's not an appropriate indicator utilized when the market is going sideways. In this instance, when you have actually sideways price action, the stochastics, again popularized by George Lane, is a much more appropriate indicator to utilize because it is referred to as a banded oscillator. It goes back and forth between 0 and 100. However, with the MACD, what you can utilize is the MACD histogram here. So as prices are advancing, you see that the underlying MACD histogram is very positive. Now, when prices are approaching this point here, now it does. I'm utilizing a 5-minute example here of the E-mini Dow, but this could easily be a weekly price chart, a daily price chart, a 60-minute price chart, or even the annual price chart that you're familiar with. But once you see prices push up into this area here, you begin to see some weakness in the MACD. Also, too, note the actual the price bar analysis. I recently did a webinar on price bars and chart patterns, and this price bar right here is a very weak price bar that closes clearly below the open. Also, too, this Fibonacci level here, the 2.618. Notice how the MACD line is the blue line, and the MACD signal line, which is the black line, basically flatline. It's essentially confirming a consolidative phase in the market, and that's where you find your 2.618 level right here. When prices begin pushing up, again, notice the MACD is very nice. Each subsequent bar is higher than the previous bar. So if you're trying to decide which one of these levels is indeed going to be significant for the day or for the time period, I would recommend two or three approaches. First one, see if you can somehow incorporate your wave analysis into this approach, and that will give you a much better idea of whether or not one level will be respected or will simply stair step up to the next level. Or you can utilize, if you're more of a computerized technician, you can utilize tools such as stochastics or MACD and the MACD histogram to identify these levels a bit more clearly. So I hope I answered that question thoroughly. Okay. Let me go. I'm getting a lot of questions at the moment. Give me some time to catch up with the questions. Well, lots of questions. Is there a software package for this? Not that I'm aware of. As far as I know, this is kind of unique stuff. Okay, here's an excellent question that some may be shy to actually answer. How do you trade this? That's a very important question because at the end of the day, that's really all that matters. What I would basically do, I would begin, let's take a look at coffee. Okay, here's my annual Fibonacci and support level analysis. Now again, if you're familiar with my monthly futures junctures work, where I actually outline instructions on how to utilize the technique, I make a very clear distinction regarding, or I give you some tips and guidelines on actually how to utilize this. For example, you can actually do a retracement, Fibonacci retracement of the January range itself. Sometimes these levels, i.e. 0.382, 0.618, and 50%, sometimes those are reactionary as well. I really like to see a price action where we push down below January's trading range, push back up into January's trading range, fail to move above it because that usually signals a breakdown or a move to the downside. But back to the original question, how would I trade this? Because I'm an Elliottician, I would tend to apply this or wrap this technique around my Elliott wave analysis. So here were some of the key levels that were identified in coffee utilizing January's trading range of 2008. And as you can see, that indeed proved significant. Now, some levels weren't quite attained. I do realize that. But as a whole, these levels are very applicable, again, throughout the year, throughout the month, throughout the week, and throughout the day. So I would start with a very big picture analysis, for example, in coffee. I have key support right here, but these levels were derived utilizing January's trading range of 2008. We've actually begun a new year, so I want to recalculate these levels utilizing January's trading range. Now, the first observation you'll most likely see with regard to coffee is that prices are still stuck within January's trading range. Now, there's two levels that I focus my attention on greatly, and that is the 1 point level and the 1 point level to the upside and 1 point level to the downside. These levels are very, very important, and the reason why, and they're also important on, again, the daily level, the weekly level, and the intraday basis. These levels are important because oftentimes what will happen is the inability to penetrate this equality range, is what I call it, basically means the market will be stuck in a sideways move throughout the year. Once we can begin pushing above this 1.0 level, then that's when we tend to have a trend of some type, either up or down, enter the market, and that's when I can begin either looking for further rally to 1.618 or 2.618. But notice with regard to coffee, what we have right now, and again, let me clean my price chart up, is that we're still very much stuck within January's trading range. This being the case, what I'd like to do is simply do a Fibonacci retracement of the range we've experienced thus far. So what I'm looking at now is the weekly price chart. Here is January's low. Here's January's high. Let me redraw that. And go on down to the daily level. Now what I do is I actually superimpose these numbers on the daily level. So what bases the front month contract, which now is currently May. So what you can see right now, again, if we were to expand the picture back up, these are the Fibonacci levels derived from the monthly bar chart of January's trading range. And as you can see, prices have actually come down. Excuse me just for a moment. It appears my computer is kind of slow. That prices have actually come down to the 786 retracement of January's trading range. Now what I would like to see at this point, because we're the last, actually since this price bar, this price bar, this price bar, the last 4 or 5 days worth of trading in this market has been very sideways. I would actually look for a break of this level here to signal further decline on down to the 1.0 level. Now, if we can get below this line on a daily closing basis, that would be a good indication that the larger trend is about to unfold. Now, also, too, it's always good as a trader to have more than one trading plan. This is trading plan number one. The second trading plan would be that we go up and test the 50% line here. Also, too, notice there's a small soft price gap right here, in which case a daily close below that would be a strong indication at that point. For example, if we do go up at this point here, I'm looking to actually short the open the next day with a stop right above the extreme here. I don't know if that was a clear example. Maybe this was a bad example because we have an inside trading range. Let me take a look at cotton. Cotton is a market that's been behaving quite nicely. And notice in this market here, and this is going to be a good example, simply because we have, again, January's trading range clearly delineated by this price bar. Now notice how prices are coming down. Now I've already said initially, that the key level I'm going to be watching throughout the year actually is this level right here. It's the 1.0 level, because again, until prices begin breaking out of that band, 1.0 to the downside and 1.0 to the upside, basically the market is telling me that a new paradigm has not been created in this market, and it's going to be basically or essentially range bound. Again, after identifying these levels on the annual basis, I then project down to the daily level. Okay, here's the low, January's low, and here's my 1.0 level down here that I really would like to see broken in this market. Okay, now as it stands right now, I would suspect something short-term, and as far as cotton, is possibly a little bit more weakness on down to about the 618 level here. And then at that point, a counter trend move back up, and this is where I'd be looking for my shorting opportunity for decline on down to the 1.0 level. Now, with regard to being a bit more specific with my actual trade setups, entry price, exit price, that sort of thing, I would actually want to see what type of Elliott wave pattern developed into this area. But I know that if prices were to push lower, bounce from the 618, back up to the 1.0 handle here, and having done so in 3 waves, that this is an excellent opportunity to rejoin the downtrend. Also, too, like I mentioned previously, if you're more of a technician, a computerized technician with regard to utilizing stochastics and or MACD, I would be looking for a stochastics signal up here that would be in the overbought territory where %K was actually pushing back below the %D, or the MACD line was pushing below the MACD signal line, or possibly divergence in the MACD histogram. So until I actually get to that point, I'm more of a standby. So I hope that actually addresses that issue. Let me see if I can get a few more questions here. And let me get my computer working properly. Excellent question. If you're a long-term trader, would you be better off doing a weekly or monthly fib? Most certainly. If you're a long-term trader, I would focus primarily on the levels derived from the annual Fibonacci support and resistance level analysis, and those key levels are derived from January's trading range. Here's a really good question. If a market goes above January's range to say the 2.618 level, and then reverses and breaks back below the January's range, i.e. the low, would you expect it to fall to the 2.618 level? Uh, and you're one step ahead of me, Tim. You're exactly right. Um, I tend to look for this quite often, Tim, and and what I'm referring to is, I don't know if many of you noticed this. Uh, this is soybeans. This is the monthly price chart, and here is again the annual fib levels derived from January's trading range. Now, what he's referring to is whenever you see a market go to one level, i.e., say the 1.618, if it comes back through the January low, will it continue down to a 1.618? Often, not always, but often, this will indeed occur. And what I'm referring to is we saw a 2.618 test to the upside and a 2.618 test to the downside. The reason I tend to look for this occurrence is because the market likes to see balance. For example, here's an A, there's the B, here's the C. This is just a straight three-wave zigzag Elliott wave corrective pattern. But at the midpoint of wave B, you actually have balance between waves C and A. What I'm referring to is wave C balances wave A. Same thing with a five-wave move. 1, 2, 3, 4, 5. The midpoint of the structure, you tend to have balance between the upper half as you do the lower half. And as you know, if you're an Elliottician, that one of the most common guidelines regarding fifth wave structure is that whenever wave 3, wave 5, and 1 tend toward equality. Again, this is the market's attempt at always continuing to seek balance. So to answer your question, Tim, even though this may not occur 100% of the time, this is a tendency of the market I do look for because I know the market has a tendency, again, to seek balance. Okay, thank you. Okay, there's more of a market question. I'm not going to take market questions that actually deviate too far from tonight's course because that's out of the scope of what we're doing tonight. Regarding some of the markets that I'm having questions with, I will be updating the Friday weekly wrap up, as of course always on Friday. So I'll be dealing with a lot of those then. For tonight, I just simply, with regard to this webinar, I want to focus specifically more on this technique, the correct application of this technique, and its efficacy regarding all time frames. You can utilize this technique to determine significant annual Fibonacci support and resistance levels. You can do so on a monthly basis, a weekly basis, and on an intraday basis. Here's a good question here. I recently came across the use of a negative and positive reversal technique with regard to RSI, utilizing from Wells Wilder. Is this a good combination with range trading? Yes, it is. Wells Wilder has done some phenomenal work with regard to the body of knowledge and with regard to technical analysis. I'm familiar with a lot of Wells Wilder's work, and it is indeed impressive. Okay, here's a good question. Okay, what is the most important thing not mentioned? I'm not sure where I understand where that question's coming from, but here's a good question from Bill. Bill, hold on just a moment. Let me see if I can pull this up. Sugar today on the 30-minute up in 5 waves. 13:45, the 5-minute exit works out to 13:40. Okay, can you comment on how you would use this tomorrow? Okay, with regard to sugar, again, many of you I know are futures juncture subscribers. This evening I actually wrote on sugar, and I will go to those pages momentarily. And some of you have already seen this work. Here was a small head and shoulders pattern that I was working with regard to sugar. But the 5-wave move that we've recently done in sugar, I believe, is wave C of a flat wave 2. We have our wave 1 to the downside, A, B, C. Here's wave 2. Now, what I would be doing with regard to the application of the technique is number 1, and Bill, I'm going to make you do the homework here, is I would begin with, say, a 60 or 90-minute price chart of the key or critical levels for the week in sugar. Now, when we open tomorrow, I would give the market about 5 or 10 minutes to begin trading, and then I would use that initial bar from tomorrow and begin to calculate the key and critical levels throughout the day. And when you do those calculations, you'll be looking at many of the same numbers that I look at throughout the day. Now let's go back to our previous slide here. I'm going to I know I'm kind of running short on time. This was supposed to be a 30-minute webinar, but I just love this stuff too much, so I tend to talk well beyond the time limit my backup staff provides for me. So I'll answer 1 or 2 more questions, and then I'm just going to thank you again for your time coming with me. Excellent, excellent question. Can we combine these levels? Can you combine annual support and resistance levels with the weekly derived levels and the daily derived levels? Most certainly. And the reason why that's so important is because what you begin to actually see with regard to the price action, and again, at any market, is clusters of Fibonacci support and resistance begin to emerge on the price chart. And basically, this is what the market is telling you well in advance of popular knowledge, well in advance before everybody really gets to that point, that these are key and critical levels. So I would actually encourage you to keep a list of the annual, the levels derived from the annual analysis, the monthly analysis, i.e. the daily price bar, weekly and intraday. And what you'll begin to see is, again, a culmination or a cluster of Fibonacci support and resistance levels emerge on the price chart. And when that occurs, you know you indeed have identified an area on the price chart that will most likely spark a reversal in price. For example, the extreme of wave 1 or the extreme of wave 2, most certainly. That about does it for the evening. Again, I've run much farther along in my analysis than I was supposed to. I would like to thank everyone very much for joining me this evening. I know it's the middle of the week and people have things to do. I have to go home and do laundry. But let me just say this. Thank you so much for your time. I truly do appreciate you joining me this evening. I hope you enjoy this work. More importantly, I hope you find it worthwhile enough to include into your current style of analysis. I know there are a few questions I have not actually answered. If you're compelled and really want an answer, if you could just send me an email, i.e. via customer service, and I will do my best to get back to you as soon as possible with the answer with regard to this approach. It's a phenomenal approach. I've had a lot of fun with it over the years, and again, what you've seen tonight is something that I've been working with behind the scenes that I have not publicly talked about. So hopefully you've got something new that nobody else is. It's a nice toy to play with. So thank you very much, and good trading.